You may know the destination, but do you know the path to take you there? This is Profits to Wealth, a show about investing and financial planning hosted by the founders of Lake Hills Wealth Management. We'll cover commonly asked questions and dive into important financial topics such as taxes, Social Security, and how to retire on your terms. It's time to talk money, planning, and freedom. Here's Jack and Jason.
Welcome to another episode of Profits to Wealth. I'm Jack Marino Jr. here with my co-host Jason Clevlen. At Lake Hills Wealth Management, our mission is to help you achieve and maintain financial freedom. And there are two things that we believe that are critical to achieving financial freedom. The first one is an efficient financial plan, and the second is an adaptive investment strategy. So if you're retired or within 10 years of retirement, having these two things puts you at a major advantage.
And the reason it puts you at a major advantage is because you have confidence in knowing your financial future is secure. An efficient financial plan means you know exactly how much money you need and you know exactly how your retirement income will be funded, all while offering flexibility to handle change, tax efficiency, and plans for the unexpected. And an adaptive investment strategy is one that focuses on protecting your investments from loss, from significant loss. While investing for growth is important, your portfolio needs to be flexible. In other words, there are times when it makes sense to be investing for growth, and there are times when it is important to protect your principal. And this week, let's talk about that. This week, the National Bureau of Economic Research has officially declared the U.S. economy is in a recession that began this past February, ending the longest economic expansion in U.S. history, which was a record 128 months. So let's talk about, market performance after an official recession announcement, Jack.
Yeah, let's talk about that. That's interesting. I have some data here from our partners at Bespoke. Looking at the last 6 recessions, let's go over the average return of the S&P 500 following the recession announcement. So 1 week later, on average, the S&P was up 1.91. 1 month later, 1.72. 3 months later, minus 1.51. The 6 and 1 year, although, was really positive. The 6 month was 5.1 or 5.01, and the 1 year is 12.37. Where do we end up this time around? Who knows? It's interesting. At the time of the announcement, yes, of course, the recession started in February. And this time around, it seems they have announced it a little more early than usual. But what's interesting is that as they announced it this week, we're almost to record highs on the S&P 500.
Yeah, every time's a little different. Hopefully this time turns out to be similar to some of those previous ones, because it seems like by the time it makes front page news, the worst is behind us, or at least that appears to have been the case based on those returns you just went through.
Yeah. And one thing I thought was interesting is that, the data on the 2001 recession 1 year later, because we're talking about averages when I gave you all the stats on averages, during the 01 recession, 1 year, the 6 month and 1 year later was negative. And if we go back to, 01, we had 9/11, the markets went down, they recovered, then we went into a recession. And so they were already high when we went into a recession. Will that happen this time? I don't know. What's different is the Federal Reserve. The Federal Reserve, as we talked about last time, and as everyone has been talking about, the $3 to $5 trillion of liquidity that's in the system over a period of weeks is a big difference maker. So, where we end up, what the numbers are going to look like in the history books, no one knows. How is this going to turn out? No one knows that. But here at Lake Hills Wealth Management, what we use is the data, economic indicators and market indicators, which will help us direct the portfolio towards either principal protection or investing towards growth. And, we do that for all of our clients because, again, if you're in retirement or nearing retirement, what is your number one concern? The number one concern is protecting what you have, right? You don't need to hit a home run anymore. You just need to hit the base. You just need to get on the base.
That's right. And, protecting principal, we've run through, and we run through these numbers a lot with our clients when we're sitting down and talking about portfolio strategy and what our expectations are. If our strategy can help reduce losses, then that puts you ahead of the game on making long-term returns. If you don't lose as much when things are going down, and you find hopefully an opportunity to buy back into some of the things that were getting beaten up by the market, well then you're way ahead of the curve as far as returns go. And if you just look at the math, and I know we've talked about this in previous podcasts, a 25% loss, to recoup that, it takes more than a 25% gain. You don't get back to break even by just making 25%. And the simplest math to illustrate that is if you lose 50%, for example, you have $1, it goes down to 50 cents. It's a 50% loss.
If I make 50 cents, I've only made a quarter back, right?
Yeah, 50% return on 50 cents is only a quarter. You're at 75 cents. So you need to make 100% on that 50 cents to get back to $1. So it's important to have an adaptive strategy that can help manage the portfolio risk at times. And now, nobody can predict every hiccup that comes along in the market. It's the major trend changes that we're trying to identify. And, if you can sidestep some of the decline on those major trend changes, well, then that's a victory.
Right. And a lot of the last couple of recessions, we saw the S&P lose 50% plus or minus in the last two. And will we get there again? I don't know. Maybe. I don't know that we're, the markets are, near on the NASDAQ 100 is already hit, basically another high, and the S&P 500 is not far behind. It doesn't mean that we're out of the woods. We're still real early in this, coronavirus-induced recession, and there's a lot of things that can go wrong. We've had a lot of stimulus that can prop up businesses and individuals for a while, so there's already, some concerns that we have. But again, even though our gut feel says that, things have come too far too fast, we don't rely on our gut because your gut can be wrong. We rely on the data. And so far, everything looks fine. Our indicators are not flashing caution, but that could change at any moment. So my thoughts or advice to you would be, if you are in retirement or nearing retirement and you've participated in this huge rally that we recently had, I think it's a good time to evaluate, pop the hood on your portfolio and have us evaluate it with you. Talk about what are your plans for the future, what is your efficient financial plan, and then try to figure out what strategy from an investment side should you use. And we recommend our adaptive strategy, which just means, hey, when our indicators warrant caution, we're going to look to protect the portfolio. And when it's kind of flashing, hey, all clear, we're going to look to grow the portfolio instead of relying on emotion or news headlines, right? So I would, go to lakehillswm.com and give us a call, 512-580-4740, or email us. You have a a contact submit form there on our website, or you can email us at jack@lakehillswm.com or jason@lakehillswm.com. Either way, we want to help you. If for some reason it's not a good fit, no harm, no foul. We all part as friends.
Jack, last week we went through a lot of the things that are helping to push this market up. We've been getting a pretty steady stream of positive headlines, and we also highlighted some of the things that could cause the market to roll over and at least, take a breather on this rally. I think all of those things that we went through are still, intact. And, one of the things that I guess the media has been throwing around lately, I had a couple clients actually ask me about this week. You're hearing the media people talk about the stock market is overbought. And, let's talk for a second. What does that mean? And is that a reason to sell, stock exposure in my portfolio?
Yeah, that's a good question. It's the market's overbought, the market's expensive. And I know we've talked about, how you measure or, the fundamentals around the stock market. How do you determine if something's expensive or cheap? There's a lot of metrics to look at. And there's also a lot of metrics to look at if you're trying to gauge if the market is overbought or oversold. We won't get into the technical minutia, but, I'll just say this. The markets typically are kind of like a pendulum where a lot of times they go too far to the extreme of oversold, which we saw in March, on March 23rd. And there's going to be periods where it goes the other way and they become overbought. I've looked at the data on this, and I know you and I have talked about this many times. And what the data would show, looking over a period of 10 years, I've looked at even longer, is really it's not, in most cases, if you average out all the times that we've gotten to this level of overbought, depending on the indicator, it really isn't that negative. Over the next 20 trading days, so 2 weeks, let's say, there is a negative bias if you average all, at least the last 10 years out. There is a slight negative bias to the markets. But there's two ways that you can work off an overbought market, right? One, you go sideways. Two, price decline. And what we've seen a lot of is a combination of the two. But I will say, to more or less answer your question, is not a reason to sell. I think that it may be a better indicator for when should I add cash. If you're adding new money in the market or to a security, I think it's a better indicator of getting in, or potentially if you wanted to take some profits if you were overweight a security. I think it's a helpful tool. But it's not the be-all, end-all, and you definitely shouldn't be using it to fully sell all your equity with hopes to buy it in lower, because you may be surprised that you may not get any negative relief in the markets. The markets may just go sideways on you, and you may have to chase it up.
Right. And really, it's not too surprising that the markets became overbought when you look at how oversold they got back in March. We had a sharp drop. A number of things turned out to be not quite as bad as feared, so the market snapped back, started rallying, to correct, some of that downward decline. Where is fair value? Time will tell. The market's trying to figure that out. Still a lot of uncertainty about what's going to happen with corporate profits and earnings and, everything moving forward. We don't have that information yet. And so, as news trickles in, the market moves on it. And we've had an amazing run upward. And, the way I explain that overbought is just, it's taking an average of the price over time. And when that, like you said, that pendulum swings, way away from the average price over a period of time, that's when it's viewed as overbought or oversold. And like you said, we've looked at the data, and just because a security or, the S&P 500 moves into this overbought, status, that's not historically a reason to just run and hide. I mean, it can stay overbought for a while, right?
Absolutely. Now, I think there are some really good buy indicators depending on how far the pendulum has swung on the negative side. But there's two things. The trend is your friend, right? So when things are going up, it usually pays to continue in that trend, investing in that trend, and don't fight the Fed. It's two things that when you're in portfolio management that you pretty much write on the wall. Now, can the trend change? Absolutely, and that's why we use a handful of time-tested indicators that will help us, come up with either protection mode or growth mode. And each one of those indicators in themselves are not 100% accurate, but the combination of all of those together has really served us well. And we continue to test them as well. So that's really the only way that we feel like you can manage a portfolio. Because just looking at, the markets are overbought, or, the price to earning ratio is extremely high. We've known so many investors over the years that have not gotten in the market because they always said, I'll buy in when it's cheap, it's too expensive. But as we've all seen, with as much liquidity and money as there is in the system right now, markets don't stay cheap long.
Right. We were just talking about this, Jack, that we might need to start changing our definition of what cheap is and what expensive is, because the multiples that investors are willing to pay, I guess the price that investors are willing to pay for a stock, how expensive compared to the profits that company has. It seems like those multiples keep climbing. The price per share that investors are willing to pay based on a certain amount of earnings that investors are willing to pay, it keeps going up as the Fed keeps pumping money in, and interest rates are at record low levels. The Fed just announced today they were committing to near zero interest rates for the next couple of years. So we're going to have low rates, and as interest rates stay low, investors tend to be willing to pay more for stock prices.
Yeah, absolutely. It's all relative, right? And so the stock market, traditionally, if you look at history, the current PE is 25, nearly 26 estimated, and then next year is approaching 20. That's not cheap by historical metrics, but what I'll say is, where else are you going to go? The big money is in pension funds, institutional investors that have a mandate that they have to have a certain amount of equity. Let's say a pension fund is funding someone's income for a lifetime, a whole bunch of people's livelihood. They have to invest in the market. They have to grow that portfolio. So they're going to be allocated to stock, right? And right here, to your point, do you want to buy a 10-year treasury at 0.73, give or take, which I would say is expensive, or do you want to invest in the market when your earning yield is paying way more than that, your dividend yield's paying more than that? And the last thing I'll say is it could be just a change in the dynamic of the market. We went from an agrarian society to an industrial society to more of a technology consumption society. And if you look at how much someone is willing to pay up for, let's say, an Amazon versus, a Citibank, it's drastically different. And those companies are growing at a drastically different rate. So you would expect over time, with as low as interest rates keep going, we've been in a declining interest rate environment for 30 years, and we get more and more of the market is growth-oriented companies, either that's in healthcare or technology, you would expect that the multiples, the price-to-earning ratios would go up. that's just kind of what my thoughts are. But, time will tell. But again, price to earning ratio is not ever been a really good indicator for, buy sell indicator on the short term. Long term, usually fundamentals or the valuations do come into play.
Markets continue to be volatile. We continue to see a lot of fluctuation in the stock market with big moves up and big moves down. That I think just continues to highlight some of the uncertainty, that is still swirling around in the economy and in the stock market right now. And I think the bottom line here is it pays to have an investment strategy that can pivot, that can be nimble and protect you when it makes sense to have a little more protection in the portfolio.
Absolutely. And again, this is the time, when the markets are high, you definitely want to evaluate your portfolio. Because again, we found this time and time again that a lot of investors do not know what risks are hiding out in their portfolio. It's not until I think Buffett said, tide goes out, you don't realize you're swimming naked. So, or the tide lifts all boats, Anyway, the bottom line is you need to know what's in your portfolio, and you need to know what risk you're exposed to, especially if you are, again, in retirement or nearing retirement. So I will close with, a offer that, if you contact us, we're going to do a lot of work for you. You don't pay us a dime. If after we do all that work, you found no value, then we expect that you won't hire us. But my thought is that you will find value. There will be value in what we give you. And it's not for me to determine, it's for you to determine. And we just feel confident that we're able to help you. We feel confident in our 15 plus years of doing financial plans for people just like yourself and investing to protect portfolios in times of volatility and negative economic times. And so we want to help you. So reach out to us and request a review. And the last thing I'll say is maybe you have some questions. You're not ready to request a review. Just email us the question. We'd be happy to answer that on offline or maybe even on a podcast. Maybe they've got a good topic for us. So, Jason, until next time, I guess keep an eye on those markets.
You got it, Jack. We'll talk to you again next week.
Take care.
That's all for this episode of Profits to Wealth, but we have more resources available to you on our website. Head over to lakehillswm.com to request a free financial review or subscribe to receive weekly insights from Lake Hills Wealth Management. Until next time, we look forward to uncovering your path to financial freedom right here on Profits to Wealth. Investment advisory services offered through Lake Hills Wealth Management, a registered investment advisor. The information and views discussed on this show are not intended to be taken as individual advice. Additionally, past investment performance does not guarantee future results. Everyone's situation and goals are different. Please consult a professional about your specific situation before taking any action.